Hello, everyone. Thanks for joining us for this Seattle Angel Conference on workshop on Angel Investing 101. We are doing this as a series of workshops every Tuesday from now until the end of August, where we're trying to work on specific things. Today, we're working of what is this angel investing stuff anyway, and how does it work? Erick is going to talk about it. Erick is our LLC manager for this round. Each round, we produce a new LLC manager. The goal is to teach how to be a lead investor by being a manager of a fund. But we will also talk about what it means to be just the first time angel investor, since half of the angel investors in the angel conference are brand new, never have written a check before. We'll sort of go over the basics. I want to call out that we're doing a Meet the Angels kind of event on July 21st, which is all of the angel groups and a couple of micro venture groups are going to be speaking. And so I'd encourage you to take a look at that. And if you have any problems, please let us know in the chat. If you are at a table mingling after we get done with the talking and the questions, we'll do a little mingling at the table so people can get to know each other. You can also chat in the chat on the side, and people can see that at both at the table and for everybody who's here. So let me introduce Erick. Erick, can you click on your picture and mic? There you are.
Here we go.
Yeah. So Erick, thank you for being the LLC lead. I appreciate it. Can you say a little bit about yourself and what you're up to?
Yeah, I have a more detailed intro in the deck, but just as in a little bit of a nutshell here. My name is Erick Watson. I've been affiliated with Seattle Angel Conference now for almost a year. Went through the last two rounds initially as just a first-time investor with the conference, and then subsequently as the assistant fund manager. And now, as John mentioned, we rotate fund managers every cycle, and so now I get to be the fund manager. So that's very exciting, and I'm glad to serve and here to help everybody in their angel investing journey. So hopefully we'll get a chance to talk about that in more detail this evening.
Yeah, absolutely. And while you're doing your talk, can you talk a little bit about the structure of the Angel Conference LLC and the structure of the sidecar deal that you might put together and what those are somewhere in the middle there?
Absolutely. No, I've got lots of little technical details for how all these pieces fit together. So
great. So let me get off the screen and you can go directly.
All right. And then let me go ahead and let's see. Whoops, I got a little screen share echo here. Let me share a different screen. I'm so used to being on Zoom calls, the screen sharing doesn't work the same way as the other screen sharing. Let's try it this way. All right, hopefully everybody can see my slide deck okay. If it's a little hard to read, if it's a little bit of an eye chart, just go ahead and maximize that screen.
Yeah, if you double click on that screen, it'll make it big, and you can choose which.
Very good. Okay, so just to kick it off, first I'd like to say thanks to everybody for coming. I really appreciate that you've taken time out of your busy schedules, or in some cases family time, to be with us tonight and learn more about angel investing and how that all works, and learn about the possibility of participating in Seattle Angel Conference. We have many current and former Seattle Angel Conference participants, as well as some new folks. So for those of you that are new, please do take opportunity to meet the other more experienced folks that have been with us longer when we have the breakouts. And for those of you that have been around the block for a while, please seek out the new folks so that we can make them feel welcome. So a little bit about today's presentation, just some basic disclaimers. I'm not a CPA or an attorney, so please don't take anything that I say here as being financial advice that might be right or wrong for you. So seek out professional help where it's appropriate. There may be some errors in this presentation. I tried to clean it up, but if you catch me on some, it's the fault is mine. This is all very risky stuff. Angel investing entails a high degree of risk, and so it's not for everyone. But we do think that it's for more people in the Seattle area than currently participate in it. So that's one of the reasons why we're here, is to help educate and get people engaged. And then always welcome feedback on ways that I can make this presentation better, so that the folks who come behind us can get more out of it. So as we get into it, I'd like to start by asking a question, and maybe you can use the chat window to the right there, to your right, to answer this question for me. How many of you know what an accredited investor is, and know that you are or are not an accredited investor? That'll give me a good sense for to this evening's makeup.
Remember that you can also use the raise hands things for yes, no votes.
Oh, okay. Is that in the, oh yeah, there you go. If you go to the participant tab, sorry about that, not the chat tab, but just the participant tab, you can raise your hand. So I see Greg raised his hand. Anybody else? Okay, Levi, Widad, great. Okay, so a few of you are familiar with this, and it looks like the majority may not be. So that's great. We'll get into some of the details on that. A little bit about me. Why should you care about what I have to say, or listen to me as someone who can propound about the various aspects of angel investing? So I have been a fund manager before joining Seattle Angel Conference, and I've built several different kinds of funds in the past, different investment vehicles, including some very sort of funky and odd ones like volatility arbitrage, secondaries, which are when you purchase a volatility arbitrage. In a nutshell, is when you trade on volatility. You're not actually trading on the underlying security. You're trading on the delta between what that security does and one of its derivatives does. So it's kind of very convoluted. Secondaries are when you purchase private shares from a company that's getting ready to go public, like a Facebook or a Twitter a year or two prior to their announced IPO. I also founded or co-founded a number of software technology companies. And so my expertise is primarily in developing software, and also in developing software for financial services applications. One of my bigger claim to fame is I got to lead an IPO on the NASDAQ for a life sciences company called Genprex, which has a variety of therapies for both cancer and diabetes. I also get to serve on multiple corporate boards for some startups here in the Pacific Northwest, as well as in Europe. And the majority of my career was spent at Microsoft in a variety of roles, including at Microsoft Research. So that's just a little thumbnail sketch about me and how I learned about angel investing, how I got into this. And so one of the questions I have for everybody, and this is not really a raise your hand question, so please feel free to use the chat. Does anybody have any specific questions that they'd like to hone in on? I know we heard from John about the mechanics of the LLC, and I'll get into that in just a moment. But just would like everybody to reflect on, if you have specific questions, would love to hear them in the chat window. And then also would love some feedback on how tonight's event and your affiliation with Seattle Angel Conference will support your goals. I'm assuming that everybody's here to learn a little bit about angel investing, but maybe there's something more that you're interested in. So we'd love to get your feedback. And then lastly, would love to get your feedback about how you might be applying tonight's information, either personally or professionally, moving forward. So stew on that a little bit, and then chime in on the chat window as you're able, and I'll try to jump in on those. For tonight's agenda, we're going to talk a little bit about angel investors, who they are, how they operate, what it means to be an angel investor. We'll talk about how to invest in startups, and this is where we'll get into some of the technical nitty-gritty about setting up special purpose vehicles and LLCs, such as the ones that we use to run the Seattle Angel Conference Fund. We'll talk about angel syndicates, which are when a bunch of angels get together to form a larger whole. Crowdfunding, which is more of a public-facing, non-regulated, or I shouldn't say non-regulated, but lightly regulated form of fundraising. ICOs, which are initial coin offerings, something that's become very popular of late with all of the buzz around cryptocurrency and tokens. And then lastly, we'll wrap up with deal flow and due diligence, which is how to evaluate a deal as an angel, and things that you might want to consider prior to making an investment. So with that, why be an angel? Why join Seattle Angel Conference? I think it's important to understand that I think being an angel investor is not strictly about financial return, but it's also about giving back to your community, being an active member and a participant in a community. And so that's one of the great benefits that I derive from being affiliated with Seattle Angel Conference is I get to meet a lot of great people, and I get to work on a lot of interesting projects with some of them. You get exposure to entrepreneurial energy and ideas. For those of us that have been entrepreneurs or still entrepreneurs, I find it a great well of rejuvenation, you might say, to be able to hang out with other entrepreneurs and hear their stories and learn about what inspires them to become an entrepreneur. It's a great place to keep an ear to the ground and learn about new and upcoming concepts that many people in the general public might not know about. It's also a great place to get some sort of inspiration for your own ideas. Maybe you have, I spoke earlier today with some people who are thinking about starting a startup, but they're not sure, or they don't quite have their product market fit figured out. And so coming to Seattle Angel Conference is a great place to bounce ideas and test some of that to make sure that your idea is worthy of the investment of your time and money and energy. And then lastly, I think even though we talk about making money as angel investors, I think that the money is really sort of a consequence of these activities. It's not something that happens because of these activities, if you will. It's something that happens as if we do our jobs well. It's important to bring the right expectations when you consider undertaking angel investing. I think it's commonly cited that most startups do fail. So it's a statistical game in which you're playing the odds. Most companies, even if they don't fail completely, are not going to return your capital. So even if they become zombie companies, as we sometimes call them, when they're still alive but not really producing a tremendous result for us, they will not necessarily liquidate their holdings and return your capital to you. You have very little control over the situation as an angel investor. Once you write that check and give your money to the startup, you basically said goodbye to that money, and you hope that at some point in the future, the startup does good and returns that money to you with some interest. Your investments will be illiquid. So this is not like buying a CD where you can cash it out with a minimal penalty. This is something that even though you might keep it on your books, it's not something you can cash out very easily. Successful investments take a long time. And a lot of people find it difficult to think on the lengthy time horizons that are sometimes required for investing in small startup companies. And so be prepared for that. And it's very difficult even for professionals who dedicate their lives full time to understand what's going to be successful and what's not. So the best way to handle that uncertainty is to diversify. Some cautions: you will likely fail to beat the public markets, right? So if you're getting into angel investing as a get-rich-quick scheme, you're in the wrong place. Most VC firms do not succeed in beating public markets. In fact, ETFs, a basket of publicly traded ETFs, typically outperforms the vast majority of venture capital firms. So this is not the kind of work that you want to undertake if you're seeking to strike it rich. And I think the key thing here is not that it's something you don't want to get into, but it's something you want to understand why you're getting into it. And I think the process is as important, if not more important, than some of the outcomes that result from successful angel investing. So earlier I asked how many of you are accredited investors. A minority of you raised your hand. An accredited investor is defined by the SEC as an individual who either is single and earns more than $200,000 a year for the past 2 years, or perhaps is a married couple who earns over $300,000 a year and expects to earn more the same the following year. Or another way to think about an accredited investor is to look at the total amount of assets that they have at their disposal. And if you look at it that way, as opposed to from an income perspective, they need to have about $5 million in assets. There are different definitions of what constitutes an accredited or qualified investor when applied to corporations. So as many of you who are small business people know, you can start your own LLC, you can put assets into that company, and then that company can become an accredited investor itself. And then, whoops, sorry, I already got some people calling me out here. I said 5 million, but it's 1 million. It's correct in the slide, but I misspoke. You need $1 million in liquid net assets. And then it's 5 million for a qualified purchaser. So I was getting those two things mixed up. Qualified purchaser is somebody who has 5 million in assets. Okay. There's also a new definition that started in 2016 called a sophisticated investor. And even though that sounds very, very interesting and kind of very, very cool, All it means is that an investor who understands the relationship that they're entering into with a speculative startup company. And where this gets particularly applicable is for financial professionals. A lot of times you may hear about certified financial planners, CPAs, or other folks like that who make investments of this nature. They are considered sophisticated investors, not necessarily because they meet all of the accreditation requirements, but because they have a unique domain knowledge about how these investments function. And so some people become accredited through the sophisticated label, you might say, depending on how the paperwork rolls. And I think it's important to recognize that essentially the SEC, if you read all the laws that have been written about this since 1933 onward, basically what the United States government is trying to prevent is they're trying to prevent you from raiding somebody's trust fund, essentially. If you're, let's say you're an elderly retiree and you've accumulated a lot of assets, they're trying to prevent some shuckster who comes in and tries to take those assets from grandma and put them into these highly speculative investments, which of course may not materialize in grandma's lifetime if she's older. So the way I like to think about it is if this is not an investment that's safe for your grandmother, maybe it's not one that she should make. And so it's only appropriate for people who can afford to lose that money, and it's got to be done in a very controlled fashion. What are some of the risks other than just losing your money that we talked about for angels? Well, once you've founded a startup company, you're happy with what they're doing, you would like to invest in their success. There's other things that you have to be wary of. Dilution is probably preeminent among these. And so when you come in as an angel, you might be the very first money that this company sees outside of their friends and family round. And as future investors come along, your percentage of that company will get diluted. And so that has a chance of diminishing your investment to a very small number. And I know quite a few investors who have invested early in very promising companies only to see that portion of the company shrink so small that even when the company did get bought or go public, it ended up being not as much money as they thought it was going to be. So that's something you have to be very careful about. And we'll talk about anti-dilution clauses and ways that you may try to protect yourself from some of that. Acqui-hires. This happens a lot of times when a founder is exhausted. It takes a lot of time and energy to run a startup. And so many times founders may get washed out and frustrated, and their companies end up getting bought by other companies for the purposes of acquiring their IP or their technical talent. And so this typically results in a poor outcome for investors. And lastly, carve-outs. Sometimes you have an executive team that wants to make sure that they protect their portion of the nest egg. That is when you consider all things in the capitalization table. And so a carve-out also is somewhat, it can at times be contrary to your interests as an investor. So keep an eye out for these things. So what happens when you invest in startups? Well, there's some risk for the startup as well. And of course, the risks for startups are litany, and we won't rehash all of them here, but here are just some of them. I think the key takeaway from this slide is that what I find is less experienced startups and less experienced angel investors typically overrate the low risks and underrate the high risks. And what I mean by that is, for example, I've met a lot of first-time angel investors who are very concerned about intellectual property. They're very concerned about fraud, and these things actually very rarely happen in practice. Most of the time, those are very exceptional circumstances where you see a case like that. Meanwhile, a lot of times they have rose-colored glasses about some of the very high-risk areas, which include product market fit, business model, founders becoming exhausted and looking for a way out, that sort of thing. And these are areas of risk that are quite high and so need to be managed very assiduously. Taxes on equity. Let's say you find a great startup, you make your investment, the startup's doing great and making money. How is your investment taxed, and how do you manage to protect yourself from over taxation? Well, the good news is when you make the investment, that is not a taxable act. As long as the investment's held for more than 12 months, it's considered short-term capital gains. Or less than 12 months, excuse me, that'd be short-term capital gains, and that gets taxed at a very high rate. So generally speaking, you don't want to invest in a startup company that's planning a liquidity event within the next 12 months unless something really magical is going to happen, because the results from that may not be as great as you think. You want it to be a long-term hold, something that's greater than 12 months, in which case you'll only be subject to 15 to 20% capital gains, depending on your area of domicile. If you hold it for greater than 60 months, it's what's called qualified small business stock. And so it has yet another classification. And so if you hold it for an even longer period, it could be subject to alternative minimum tax, which is a very complex tax topic that I won't get into in this presentation. But suffice it to say that if you have a very long-term hold, you may want to talk to an accountant to see what the best way to handle that is for your situation. Just know that I think the key point here is capital gains start after you've made the investment, and they're only calculated when you cash out, not when you cash in, so to speak. Different instruments. So earlier, John alluded to how do we structure our investment, right? The way that the Seattle Angel Conference is structured is using what's called a special purpose vehicle, which is a type of limited liability corporation. And it's basically, I think of it as a bucket, really. It's just a basket that we put everyone's money in. And then it's a container that allows us to govern this money as a single transaction and being governed by a single person, which in the case of Seattle Angel Conference 18 is myself. And then when we write that check to a startup, they get the proceeds from that bucket of money, that LLC. And then that company is managed in perpetuity by me. And the way that we manage it is I communicate on a quarterly basis to our investors until the investment realizes its maturity. And that maturity could be a fantastic IPO or something in the middle or a complete failure. But every year, investors will get a K1 from me describing how the investment has done, whether it's been marked to market, that sort of thing. The instruments that thanks, John, for that prompt. A K1, for those of you that may not be aware, is a reference to the tax form that is used to calculate the portion of your investment. So for example, if we have 40 people in Seattle Angel Conference 18 and they each put in $5,000, then we have $200,000 that we put into the company. A K1 would represent your portion or your $5,000 share that has gone up or down in value over the course of the year. And then that is reflected on your K1, which then gets attached to your tax returns, your personal tax returns. Let's see. The convertible note is typically what we will use as a tool to make our investment. And so a convertible note is sort of a legal obligation between Seattle Angel Conference Fund and the winning company that receives the investment. And basically, the way the convertible note works is it has a duration, an interest rate, and some conversion provisions. And what conversion means is that it's initially treated as debt. And so when we give them this $200,000, it's treated as a loan, and it accrues. It has an APR, an interest rate that is accruing over the first couple of years. And then later, usually triggered by a certain event, such as a follow-on round of financing or a liquidity event or a purchase of the company, that debt will convert into shares in the company. And it will convert based on certain valuation parameters. And so the convertible note includes all of those different parameters. It talks about things like what is the valuation cap of the company, because we want the conversion to occur in a way that gives us a reasonable portion of the company for our early investment. We don't want them to wait 5 years and then convert when we're 1 basis point of the company's cap table. We want it to be substantial so that we can participate in the upside. There's other instruments that you may hear about as you learn more about angel investing and startup investing in general. One is called a SAFE note. SAFE is short for simple alternative to future equity, or I think it's, simple. I should know the answer. Yeah, it's basically a promissory note that says, we're going to make an agreement now that at some point in the future, we will come to a price decision about what portion of your company this money is worth. Thanks, Adam. Simple agreement for future equity. That's what SAFE stands for. And then there's Series Seed, which is another type of round, but basically it's It's very fast. It's made to support a quick transaction. Generally speaking, I don't like either of these instruments. And the reason I don't is because I feel like it leaves a little too much to the imagination and sort of kicks the can down the road for future circumstances. You hear a lot about safes and Series Seed in the Bay Area because I think investments in the Bay Area are typically a little faster and looser than they are here in the Seattle area. And so sometimes people just want to get the money and hurry up and make it happen and figure out the details later. Generally, I prefer to do a convertible note because it's equally as simple as these other devices, but it has a few more provisions in it that allow us to establish some parameters and decide the scope of our investment. So mechanisms for coming to terms, ways that you arrive at an agreement with your startup company that you're investing in. You can do what's called leading a round. And so technically, you might say that I'm the lead for this round of Seattle Angel Conference. And that means that I'm responsible for buttoning up all the paperwork, making sure that we have all 40 of our investors onboarded, keeping them informed as to what's going on with the company that we choose to invest in. So that's an example of leading a round. Sometimes you might hear of a more sophisticated lead in which you have multiple venture capitalists or angel investors involved in a round. And the lead person is usually the one who sets the terms and handles the paperwork for the rest of the folks who typically are not leading by virtue of the fact that they're not investing as much as the lead investor is. There's also what's called a following term, which is just the inverse of leading. And then there's a thing called a party round, which is basically where there's a whole bunch of people who just kick in a little bit of money and decide to see what happens. And so party rounds are kind of, I think, an indication of poor health in a way, because it means that a bunch of venture capitalists or angels looked at this company, kind of felt sorry for them, gave them a little bit of money, but nobody had a sincere enough interest in the company to actually lead around and be highly engaged. And so whenever you see or hear of a party round, I would usually advise caution, because that suggests that they were able to secure very small amounts of money from a very large number of investors, none of whom felt sufficiently motivated to lead the round. So that's, to me, is a yellow flag. How do you source deals? As you become an active angel investor, this becomes more and more of a problem, because it is difficult to keep an ear to the ground as an individual person and understand all the different deals that might be going on around you. We enjoy a very rich and diverse startup community here in the Seattle area, and so we want to make sure that we're in deal flow. How many of you have heard of some other angel groups in the Pacific Northwest? If you know of an angel group in the Pacific Northwest other than Seattle Angel Conference, please text me in the chat, and we'll cover those. But to suffice it to say, there are several, and by participating in each of these, you can broaden your scope and have access to more deals. Some of these different organizations charge a fee for their services. Some of them have very formal and rigorous due diligence processes, and so that's what your investment in your membership goes towards. Typically, is a very professional due diligence process that's very tight. And so, yeah, I see some people got E8, Space Angels. There's Alliance of Angels. There's quite a few. Keiretsu Forum, yeah, we can't forget Keiretsu Forum, Nate McDonald. So he runs Keiretsu Forum, great group. And there's still more. There seems to be more popping up every day. So some tips. How do you become active in the sourcing community? Being known for something. I think it's important. One of my very favorite VCs that I like to work with, who's very good at this, is clear on what he wants to be known for. He only invests in certain kinds of companies. And so I think it's important that you as an angel investor also be known for the types of companies that you want to invest in. And typically these are things that you might have an ability to contribute to based on your particular set of competencies and your background in the business world. Reach out, network at events like this. I mean, I think that goes kind of without saying. And then if you're really struggling to find deals, or you feel like the deal flow is not as good as you'd like, I encourage you to check out places like AngelList, Crowdfunder. There's lots of online resources nowadays, Gust, and some of the other angel groups that we mentioned earlier. Some flags for early stage companies, some things that you should be aware of as an investor and take as a cautionary statement. If an early stage company wants to start the conversation with an NDA, chances are that is somewhat of a misplaced fear. We see a lot of that, and sometimes people think they just invented a new cure to world peace or world hunger, and so they need to have you sign an NDA before they disclose anything to you. That's usually an indication of someone who's not had much experience in this realm and is just getting started, and so that's kind of a yellow flag. Not a Delaware C Corp. The reason why people encourage these companies to become C Corps, and specifically in Delaware, is because Delaware has the most robust provisions for shareholders. And so you as an investor will become a shareholder in this company, and you want to make sure that the company is structured in a way that is as favorable to your interests as an investor as possible. And Delaware C Corps are sort of the gold standard by which others are measured. There's other states of incorporation that you can explore, like Nevada, for example. I don't think Washington is all that bad, but for a company that really wants to go big and become successful, Delaware is kind of where it's at in terms of incorporation. And then patents. A lot of times I find early stage companies are very worried about their intellectual property. They may or may not have filed for provisional patents. Just know that, and some of you already know this, usually a patent takes several years to prosecute and actually get done through the patenting system. And so, and it also takes a great deal of money. And typically that money could be better spent at an earlier stage of the company's life cycle. So when you see a very early stage company spending on patents, it better be for a particular kind of company for whom patents are essential, like life science companies, for example. Software, consumer software companies are not as, software patents are not as essential for them, I would say. Flags for you, things you want to be watching out for. Some of the folks in the audience work for large employers here in the Seattle area. You never want to get into a situation where you find yourself at conflict with your employer by investing in a vendor or investing in a company that the employer's already made an investment in, because this can just create even the appearance of conflict of interest, which can be very detrimental to your reputation inside and outside of the employer. Also, you want to avoid portfolio conflict. If you've already made an investment in a thermonuclear mousetrap company, you don't want to make another investment in a separate thermonuclear mousetrap company, because then it's going to look like you might be taking secrets from one and giving them to the other. And so that creates a bad impression as well. So please try to avoid those kinds of things. How do you value your investment? How do you know how much to invest and what it's worth? At a very early stage, I like to say this is mostly magic, because it really depends on comparables, and there's just a lot of unknowns, and it becomes very, very difficult other than just developing an educated opinion. And the reason for that is revenue cash flow multiples only work on mature businesses. They don't really work well on startups. And so an easier and saner way to do that is to look at the total addressable market, or TAM, and then weigh that against the risk of dilution. And so what you're looking for an early stage company is something that's got an enormous total addressable market, and that with even just a little bit of money can develop a commanding position in that marketplace. And so that's kind of the ideal sort of gold standard is you want some sort of blue sky opportunity where this company can just jump in with very little competition and command a large chunk of the market. How do you be a great angel? What are some of the behaviors that you want to emulate and pass on to others in your network? Be active, be participatory, get involved, share ideas with people, share ideas that are not related to your area of focus in your employer, right? We have a lot of smart people here at Seattle Angel Conference working on some very confidential things at some very large companies. And fortunately for me, I've never had cause or indication from any of them that they shared any of their secret sauce with any of our startups. And that's to be expected, and that's highly professional. So we want to keep that going. Toot everybody's horn, give somebody some free marketing when they can. It's very effective for startups who are just getting off the ground. They rely very heavily on you and your personal network. And so being a great angel is about creating opportunities for the startups in your portfolio. And then find other investors, bring a friend, bring other people who are interested and can help. Being a bad angel, what are some bad things to do? Leaking information, not keeping companies' data in confidence, demanding special rights, which are really sort of difficult to enforce and particularly damaging at an early stage of the company, such as retainer agreements, right of first refusal, halting a sale without your approval. I once worked at a startup that had spent $2 million, and the acting CEO and chief revenue officer were both drawing $20,000 a month in retainer fees each on this little company where 15 other people were working for peanuts. And that was just a horrific situation, and it ended badly. So these are some examples of how to be a bad angel. Calling notes, basically putting debt in front of your equity is also bad behavior, and it's going to be very destructive for the startup. Attempting a board takeovers. I've seen some very heinous board behavior in small startups where people's egos get involved. And so please try not to get into a situation where you find yourself compelled to do such a thing. And then just micromanaging the startup, right? These guys have enough to worry about and are working on becoming successful. Having you breathing down their neck is not helpful to you or them. So overall strategy for making these investments: get buy-in from your significant other. I can't tell you how many times I've spoken to someone who made an investment in an angel investment in a small startup without first consulting their spouse or their partner. And that's just a recipe for trouble. Regardless of how you manage your personal finances, it's best to have people fully engaged. And we have Kate Fuller-Ghaffari, who's our assistant fund manager this round. She got involved through her spouse, who brought her to her first Seattle Angel Conference, and now she's front and center and doing some great things for us. So we're very excited to have her. So this can turn from a negative to a positive. Don't invest more than 10% of your net worth. One of the numbers that John often likes to rattle off that I parrot as often as I can is that if you're an accredited investor, you have $1 million in liquid net worth, and you take 10% of that, that's your investment pool for startups. If you want to be statistically successful at making investments in startups, you need to make a minimum of 20 investments, which means $100,000 divided by 20 is $5,000 per investment. And not coincidentally, that is why the Seattle Angel Conference Fund's shares are priced at $5,000, because the idea is you buy one share, you get exposure to one startup, and then you build the rest of your portfolio over the coming months. And so that's the basic math of that in a nutshell. And then you want to build a basket of as many startups as possible over a 10-year period. When I say as many as possible, really it's between 20 and 100. We have some very active angels in the community. Kurt Billifer, who was our fund manager last round, he's invested in over 100 startups. And so statistically speaking, the likelihood that his investments will pan out over the next 10 years is quite high, simply because of his ability to diversify. All right. How are we doing on time, John? I've got some stuff about angel syndicates and then a little bit about deal flow, and we'll bring it into the finish line for Q&A.
Yeah, I would do it relatively quickly.
Yep, very good. So I'll just blow through these last couple of slides. Crowdfunding. Customer money is the best money. So for those of you that are thinking about developing a consumer product, crowdfunding might be a way to go. But it can be challenging. So just be aware. And when investing through crowdfunding, don't expect the same kind of treatment that you might receive as an angel investor who's purchasing equity. ICOs, I have a whole nother separate presentation on ICOs, or initial coin offerings. Suffice it to say that they remain highly speculative, and there are not many successes as yet. So things to look for in an ICO are a token that can be bound to some actual valuable tangible asset. So there are things called stable coins, for example, that are directly correlated to a specific dollar amount, so that you can get your money in and out, and it's not just a pump and dump scheme. So I would be very, very careful about participating in an ICO. Lastly, just a couple points on due diligence. Be sure to join someone you trust in the due diligence. Bring useful people, bring divergent opinions. I think one of the great things I learned in going through the due diligence process with the Seattle Angel Conference is we get as many divergent opinions together in the group as possible, and naturally we end up making better decisions as a result. So you want to apply this to your own personal due diligence as well. Have an opinion, have a voice, have a point of view. Don't just sit back and idly observe, but participate actively. Solicit others. This is something that we do constantly here at Seattle Angel Conference. We're talking to friends and family, making posts on social media, talking to other industry folks about what we do. This is a great way to build your personal network and also to bring others the benefits of angel investing. Let's see. And then evaluate, basically this is when you kind of come to your decision point. And lastly, take action. Don't screw around with people, especially entrepreneurs. They need a decision and they need it fast, because even a no is okay as long as they get a rapid decision. So please don't string them along. Give detailed feedback, because every opportunity to get a no is still a gift, because especially when you tell them why you chose to pass on the investment. And then finally, make an effort to get to know people who might be interested. So even if you're not interested, maybe you can make introductions to other folks who are more interested in those types of investments. And so with that, this is my happy mug and my contact info, which will also be in the chat. But thanks everyone for your time today, and would love to take questions.
Where are you taking questions?
Well, let's see. That's a good question. We can either do chat, or we can devolve into the tables.
Yeah. So I see Levi is asking a question. Let's be proactive and drag.
Yeah. So Levi asks, how many startups can one invest in through SAC in a year, hypothetically? Great question. So SAC
we'll
runs.
drag him up here.
Oh, cool.
He has to hit the accept button.
There we go. Sorry, it took me a second.
Hey, Levi, thanks for coming up.
Yeah.
So just to answer your question directly, how many startups can you invest in a year? The theoretical maximum would be 100, and that's strictly theoretical, because we'll be introducing you to 100 companies in a year, 50 per 6-month cycle. But of course, that's unlikely that you would want to invest in all of those. The minimum would be 2, because we'll invest in 1 every 6 months. But in my experience over the last 12 months, what I've seen is that the average is more likely to be anywhere from 3 to 6. And the reason for that is in some rounds, in our most recent round, we had a tie. And so we had 2 companies that received investment from us directly. And so everyone who was an investor in that fund is now shareholders in these 2 new companies, right? The round prior to that, we invested all of our money into a single winning company, but we also created what's called a sidecar fund. And a sidecar is just a simplified administrative structure that allows us to raise a second or even a third fund under the same administrative constraints that we establish when we build the Angel Conference Fund itself. And that allows us to make separate investments in these other companies that may have come in 2nd, 3rd, 4th place in our list as a group, but there was enough of a interest in them by a subgroup, a subset of the group, to make a meaningful investment. And when we say meaningful investment, we generally mean anything above $100,000. And the reason it's $100,000 is because it costs $5,000 to $8,000 just to set up the fund and create the vehicle through which the investment is made. So with those kinds of costs, those kinds of fixed costs, you generally want to have at least $100,000 to kind of make the math pencil out nicely. You could do it with less. Some startups may take you directly on their cap table, but typically they want you to go through some sort of intermediate vehicle and investment fund, and that's why we set up these sidecars. So I would say if you start today and you join SAC 18 and you're seeking to maximize your number of investments over the course of the next 12 months, you could probably make 5 to 6 really solid investments during the next 12 months.
Although
to
be careful,
Mm-hmm.
SAC is investing in and seeing and investing in very, very early companies that are very early. And so almost all of the other angel groups that we talked about in the chat are later. And so some of the risk has been reduced out of those companies because they're later stage. Mm-hmm. And so to build a reasonable portfolio, you would like to have it diversified over time. You would like to have it diversified over sector or some other aspect of things. And so you would more likely build a reasonable portfolio by doing like grub stakes or sea change, where they're, a little bit later, a little more traction, a team a little bit more solid. And so the Angel Conference is not the best way to build a portfolio of 20. It's a great way to start. It's just not the great way to finish.
Got it. Thank you.
Yeah, great feedback. I see we have another couple of questions from Suchir. Suchir asks, what if the company is invested in Washington? Would we advise such a company to dissolve and form a Delaware Corp? First, I would say, no, don't dissolve the company. If you're seeking to secure institutional investment, I would recommend that you basically do kind of a flip, which is to say you create the Delaware Corp, you assign the Washington company as a subsidiary to the Delaware Corp, a wholly owned subsidiary to the Delaware Corp, and then you update your registration in Washington to be what's called a foreign corporation. So in other words, you're basically moving your address over, and you're assigning all of the assets from the existing company to the new company. And I think that would minimize the amount of administrative paperwork that you might have and the administrative cost of doing that. But you basically have to update all of your operating agreements to say Delaware instead of Washington and stuff like that.
So from the angel point of view, most Washington angels invest in Washington companies just fine. And so the process of going into the Series A is probably the place where this makes some kind of perceptual difference to the venture capitalists. And so this is not an urgent question at the early beginning. It just might be a tidying up kind of question for when you're getting ready for your first Series A round.
Yeah, John's exactly right. It's an administrative detail. It's not something that you should lose any sleep over or fret about if you haven't tackled it first. Next question is, what is generally the percentage that an angel investment would be looking for? What about board seats? So in terms of percentage, the percentage really doesn't mean anything in the absence of a valuation. So you need to have a perceived valuation of the company or a plausible valuation of the company that that an angel investor would want to agree with in order to make an investment, right? So if you say, hey, my company's worth $1 million, I had a friends and family round, and we think the company's worth $1 million, and we're going to have a post-money valuation. We're seeking 500,000, and so we're going to have a post-money valuation of 1.5, right? If you can get an angel investor to agree to that, then you're successful. And then the question becomes, well, what percentage of my company am I selling in exchange for $500,000? And the answer in this example would be 33%. But that may be too much for you. That may not be what you want to hear. So then the question becomes, how can you get the agreed upon valuation higher so that the percentage of the company that you're selling is smaller? And the answer to that is very simply deliver the goods, right? You want to show that you have customer traction, that you have a viable product market fit, that you have paying customers, that you have meaningful intellectual property that can't easily be duplicated by others in some cases, depending on the nature of your business, what kind of business it is. Those are all things that would contribute to a higher valuation. Let's see. Bob says Delaware LLC, so no rush to do it now as we're seeking angel funds. That's right, Bob. So you can. It doesn't take a lot of money or a lot of time to change your structure, either from LLC to C Corp or from Washington to Delaware. So don't sweat too much about that. It's just an administrative detail. If you've already engaged with an attorney to do all your paperwork, this is one of those kinds of things that they can probably do for you in a couple hours. If you haven't engaged with an attorney, that's okay, because most of the information on how to do this is available online. Just be thoughtful about it and seek advice of those that have done it before. Other questions, thoughts before we adjourn and go to our tables? Well, I hope everybody found value in the presentation. I'll be happy to share it and post it so that you guys can have that. Oh, Without asked a question about sidecar. Would a sidecar be a new separate fund? Technically, it would be a separate vehicle, a separate entity, right? It would have a different EIN number, federal tax number. It would have a different bank account number, but it would have the same paperwork and structure as the original fund. So sidecar is just kind of a slang term that we used to say that we're copying this one fund and creating another fund and doing it a little less expensively than we did the first time. Let's see, John Benjamin, in the example of a convertible note, the term was 12 months, 6% interest, 20% debt count. Is 12 months typical in Seattle Angel Conference? I don't think so, but I'll defer to John on that one.
No, we typically are picking 18 months, give people a chance to do some fundamental transformations. Our hope is that they've done their next round in 12 months, but our experience is that they don't. And so rather than calling them back to the table early, we would rather have them have some room to do some working and hit the milestone before they get their next round. Really, a convertible note is explicitly designed that you will get a next round of funding, and that sets the price. And so our intent is to give them the runway to do that, but not to give them so much runway that they don't get anywhere and get lost in the swamp. Cool. So giving people a moment for another question. Yeah, there we go.
Okay. Based on accredited, I'm not qualified. What would be your suggestion for me who's very much interested to move forward? So for someone, so let me go back to that slide just real briefly. There's actually two different definitions. There's accredited and qualified. Accredited means that you have a certain amount of liquid assets. Qualified means something a little different, but I think what you mean by your question is you're not accredited. And so if I can find that accredited slide, net, I would say if you're nowhere close to becoming accredited, and I lost it in all of my slide mess here. If you feel like you're nowhere close to becoming accredited, then I would say, but you're very interested in the due diligence process, consider tag teaming with an existing angel to become what we call a proxy or sponsored angel. Now, proxy angels and sponsored angels are slightly different, but the way that I like to net it out is that you are investing, you're managing the investment on behalf of someone else. So, for example, if John said to me, "Hey, Eric, I want to invest this $5,000, but I want Sahasan to manage this investment for me," you would then go through the process with us, decide which company to invest in, do the due diligence, and John, in that example, would have underwritten that experience for you, right? And so the goal of Seattle Angel Conference is to grow more angel investors, right? So we want to introduce people not only to the process, but we also want to help you accomplish your goals so that you become accredited and that you can participate.
So there's also other pathways.
Mm-hmm.
So accredited is a definition from Reg D that formed the SEC. And we use Reg D, typically Reg D 506B, which allows for accredited investors to make certain kinds of investments. But there are other pathways, other exemptions. One of those exemptions is Reg D 504, which is the intrastate exemption. And we have an intrastate opportunity, which is the intrastate equity crowdfunding law, which allows anybody in the state of Washington to invest in a Washington company. So if you go to dfi.wa.gov and you look up the small business crowdfunding rules, it defines how someone who is not accredited can yet do an angel investment into a company in the state, but it has a different set of constraints. In addition, you can look at things like Republic, I think it's republic.co, which is a crowdfunding platform. So the Fed has a rule called Reg CF, which allows a company using federal exemptions to do crowdfunding. Now, the company is the thing that decides which exemption they're going to make their offer under. And so you have to talk to the company about their offer, and then you can invest in companies that have an offer that you meet the criteria for.
Gotcha. Thanks, John. So David asks, can you explain the 20% and 6% points in the earlier chat? So in that example, John Benjamin states, a convertible note as 12 months at 6% interest. So that's just simple annual percentage rate. So if you invest $100,000 in 12 months, that $100,000 you are now owed $106,000. That's 6% straight interest, right? The 20% discount he's mentioning in his item here refers to the discount that you as a buyer would get on the face value of the shares. So for example, if in 12 months this note were to convert into some number of shares in the company, you would be able to purchase those shares at a discount. So if the shares were valued at $1 a share based on the float and how the cap table had been structured, you would be purchasing your shares for 80 cents. So you would get $1 worth of shares for 80 cents because you had a 20% discount on your purchase. Does that make sense? Okay, so that's an answer to David. Bob asks, do you ever get the money back if they don't go on to the next round per the APR interest and loan? So that's a great question, because if let's say something goes sideways and you have a promissory note outstanding and they don't do another round, and they don't convert for some reason, then your promissory note is considered debt. And in the case of a bankruptcy or a liquidation, debt holders are first in line before equity holders. So let's say, for example, something, the company made $1 million, but then something catastrophic happened and they had to go into receivership and file for bankruptcy. If your promissory note had not converted, then you would be on the list of debt holders who had a claim on that company's assets in bankruptcy. So if they convert, then you're an equity holder and you're behind all the other debtors. So if they owe a vendor, for example, some money, that vendor is going to get paid before you as a shareholder get paid. Let's see. And then as far as getting the money back, Bob, if you get it back in debt, that's great. If it's equity and the company goes bankrupt or something, chances are you're not going to get much back. I have seen situations where somebody's invested $5,000 and then 3 years later the company goes bankrupt and you get $500 back. But of course, you're not going to get the full face value of the original investment because there's just not as much there. Martha points out, as a proxy, you neither lose the money nor get the returns. So yeah, so there's a double-edged sword. You might get a good lesson in all of this, but you're not really participating because you're neither winning nor losing. You're kind of standing still. So Hassan, we want to help you become a player and be able to be active. So that's good.
So any last questions before we break up into the small table discussions? So what we would like to, we have in the room entrepreneurs who are interested in getting investment. We have people in the room who have taken investment. We have people in the room who have done investments. And we have new investors who have never invested but would like to learn how. And so we'd like you to move around the tables. Remember that if you click on the tile view, you get bigger pictures, makes the conversation better. If you're enjoying a conversation, stay at your table. If you're not enjoying the conversation, move to another table. We have about 20 people here. It would be great if you connect with a bunch of them. I think it'll be useful. So, and remember that we have a workshop next week, which is the financial modeling, which is one of the places we see a lot of friction with companies. And then the week after that, we have the Seattle Angel Groups Ask Me Anything, where we have 13 different groups that'll all be here. So we'll be able to explore that. So bring your friends to both of those. So thanks very much. I'll see you at your small table.
Thanks, everybody.
Thank you, Eric.